Hello and welcome everyone this afternoon. So you've seen China market going through a very interesting phase over the last few years. Many of you would be our existing investors in our Greater China Fund. And over the last 1 year, again, it has been very, very eventful for this market, be it on the tech side, what's happening in the Chinese market, post pandemic. This is one region which has seen as a very promising region to come out after the pandemic. And today we have a very interesting guest with us from our partner JP Morgan. We have Alex, who heads the investment specialist team at APAC and emerging market equities at JP Morgan. We have Supreet Bhan, who is the executive director and head for Asia funds at JP Morgan. Supreet and Alex together will take us through what's happening in the Greater China region, what's happening in the fund, and what lies ahead. So over to you, Supreet, for this interesting conversation between you and Alex. Thank you.
Thank you, Niranjan, for that kind introduction, and good afternoon, everyone. I want to start by thanking you all for your time. As Niranjan mentioned, we have done these kind of conversations in the past as well. Just for context, the Greater China Fund in India actually marks a milestone this year. The strategy was launched in August of 2009 in India. So just in about a month's time, it will complete about 12 years since inception in India as well. Since that period of time, the NAVs come close to 60 rupees, which means that for an IPO investors, the assets would have grown about 6 times. If you were to look at 10-year returns, it's close to about 16.5% annualized returns for the Edelweiss fund. Over 5 years, it's about 25% and so on. So it's got a long and consistent track record, which we will bring you towards. But just before that, as Niranjan pointed out, I am delighted to be joined by my colleague, Alex Treves, who is the APAC head of investment specialist for our emerging markets and Asia Pacific equities. It's a bit of a mouthful. In summary, he's the star speaker for the webinar today. The last call that Alex and I did on the topic was approximately 5 months back, and I looked up my call records. It was actually the 10th of Feb. I recall at the time, borders were still closed, and Alex was in the UK at the time, where he is originally from, and unable to travel back to Hong Kong at the time, where he is based out of. The good news is he's back in Hong Kong, but the bad news for him was that all of England's Euro matches were at an ungodly hour of 3 a.m. Hong Kong time. But we're delighted to have him at least in the Asia time zone as well. The call today is quite timely because, as Niranjan pointed out, in addition to the 5 months since our last update, there have been a number of headlines, particularly around Chinese regulators' action towards some big tech or technology companies. So today, we are going to be discussing the long view, the longer term prospects, try and spin in these near-term concerns and explore if these near-term concerns offer any opportunities. Just for context, the Greater China Fund invests across 3 main markets: China, onshore, and offshore. If you're wondering what that means, we're going to demystify that through the course of our discussion. Taiwan and Hong Kong. But because majority of the opportunities come from China, we are going to spend a commensurate period of time in our discussion on China as well. Through the course of our discussion, Alex and I hope to bring across 3 main points to you. First being, China is globally significant. It is the 2nd largest economy and the 2nd largest capital market in the world, but also it's progressively getting more prosperous. Second, we as investors are particularly interested in high growth areas which are beneficiaries of widespread technology adoption, healthcare innovation, and also consumption within the Greater China region. And finally, we will present to you that the JP Morgan Greater China Fund, which is present in India through the feeder fund that Edelweiss has, is a leading strategy with a proven investment process, comprehensive research team, and a strong track record. With that agenda set, let's dive into the first point that I made, which is China is globally significant. So if you can go to the next slide, I want to emphasize to you, as I mentioned, that China is the second largest economy. So if you notice on this left-hand side, it is currently about $15 trillion in size. The largest economy we all know is the United States at about 20 trillion. But in this decade, China is expected to take over as the largest economy in the world. But that's not the interesting bit. The interesting bit to me is on the right-hand side. On the right-hand side chart, on the x-axis is the urbanization ratio, which you're quite familiar with. On the y-axis is real GDP per capita, which is widely recognized as a measure of prosperity. So for context, what we've done on this slide is to show you two other markets or economies like South Korea in green and US in blue. We've shown you how as the economies progress and go from largely being an agrarian society to becoming more urbanized, as is in the case of South Korea, you see at about 60 to 70% urbanization ratio, that economy goes through an inflection point where the prosperity or real GDP per capita goes through an exponential growth, as you can see in South Korea. And of course, US went through that several decades back. What we've also done for you is to point out where certain countries are. So, you can notice 2020, that arrow that's pointing to where China is today. It's at about 60% urbanization with the GDP per capita at about $10,200. We've shown you the next dot, which is meant to be 2025, and that third dot, which is pointed as 2030. So in this decade, China is expected to hit 70% urbanization ratio, which is typically around that area where you've seen economies go through that exponential growth. So in summary, China is already getting prosperous, and as it evolves through its evolution, you're likely to see Chinese consumers become a dominant force in the global economy as well. I've made a lot of tall claims in my opening comments. I'm going to bring in Alex to do the heavy lifting of validating some of those comments. Alex, walk us through whether consumption in China is really now meaningful and what are the long-term drivers of the opportunity in China.
Great. Well, thank you, Supreet, and thank you to everyone for dialing in. It's a huge pleasure to speak to you this afternoon. What I'm going to do, I think, is I'm going to take this notion of consumption, and I will validate it as requested, Supreet, but I'm going to turn it on its head and say that although consumption is where a lot of people like to focus their energy, although people like to look at the demand side in China and get very excited about the potential of 1.3 or 1.4 billion people in the middle class buying things, actually, the most interesting investment opportunity is on the supply side. So let's go through that piece of logic. If we can go on to the next slide, please. What you can see here is that, for sure, the Chinese consumer has come of age. And I've been in the region for 25 years, and I remember when consumption out of China was really not on anyone's radar screen. And over the course of that period, the contribution to global growth of the Chinese consumer has gone up by a multiple. And you can see that on the left-hand side of this slide we're looking at. So the red bars at the bottom of this slide, you can see that China has gone from being well under 10% of global consumption growth to being nearly a quarter. And we would anticipate that that number keeps on going up over time. And of course, this is in a variety of areas. So some of the consumption is in staples. It can be in things like soy sauce or meat products. Some of it's in more discretionary areas, and some of it's in spending on luxury goods. So, the Hong Kong has been going through a difficult period over the last year or so because the people who bought the most fancy handbags or the cosmetics and things like that haven't really been able to get here. So there's the consumption side. But let's not talk about demand. Let's get really excited by supply. And I think this is a slightly different approach than many people will take to this story. And for that, can we go on to the next page, please? Now, here's a little bit of a history lesson. Back in the mid-90s, when I first arrived in Asia, and I was in Hong Kong, and Shenzhen was a small town on the north border of Hong Kong. If you think back to those days and you ask yourself, well, what did I own which was made in China? The answer is not much. And if you did own anything made in China back in those days, a generation ago, it was probably trainers, clothes, cheap furniture, maybe a cheap radio, nothing branded, nothing fancy. And that's because, putting it very simply, China didn't make much which was exciting. Now, look at that sort of gray, that greeny line on the left-hand side of this slide, please. That is Chinese patent applications, which go from basically 0 back in 96 to being the largest number in the world. And on the right-hand side, you can see Chinese R&D spend as a percentage of GDP, which has gone from being many orders of magnitude lower than we saw in Japan or Germany and the US to catching up very quickly. Now, that is extremely significant because we can get excited about the Chinese desire to buy handbags and things like that, but it's the Chinese ability to make high-tech goods, which we think is much more interesting as an investor. And if you only remember one thing from my slides today, please make it this slide here. Because of course, today's patent application is tomorrow's innovation. Today's R&D is the earnings that companies will generate next year and the year after that and the year after that. So this for us is the sort of the lead indicator of Chinese innovation for years to come. So the question then is, how do we monetize that? Why does that matter? And here is one example, I think, as a sort of a teaser for that on the next slide, please, which is new energy vehicles. Now, there are a couple of things happening at once here. One is that the Chinese government particularly wants a cleaner and more sustainable environmental picture over the next generation versus the previous generation. So there is a top-down push for people to buy cleaner vehicles, new energy vehicles. But also amongst Chinese consumers, the younger generation coming through who want cars, they are more likely than their parents to want to buy electric vehicles. So far, so good. Now, what that means is that China is already the world's largest market for electric vehicles. And tying that back to Supreet's opening comments, that means that this demand power is coming through. But if you have the demand and you don't have the technology to meet it, then you don't have an earnings opportunity. And that's why the innovation is so important, is because China isn't just generating sales of vehicles to Chinese consumers, it's also making those vehicles. We have Chinese brands, we have Chinese component companies. The largest battery manufacturer for EV in China is one of the names in the portfolio. We have Chinese smart headlights, we have Chinese steering systems. And that's how you make money, is by investing in the companies which are innovating to meet that consumer demand. And I don't think we hear enough about that. So that's what I'm going to speak a bit more about during the course of this conversation.
It's interesting because Alex, since I'm based in Singapore and I can't afford a car. Well, owning a car in Singapore is atrociously expensive. On top of that, I have 2 high maintenance daughters that I need to put through international schools as well. But I do the next best thing to owning a car, which is follow developments in the automobile industry. And to your point on innovation in China, while everybody's familiar with Tesla and the autonomous technology in Tesla, actually the record for the longest autonomous drive is not held by an American or a European company. The record for the longest autonomous drive by a mass production car is actually held by a company called Xiaopeng, or XPeng for short, where the P7 car actually drove 3,000 kilometers from Guangzhou to Beijing with an average human intervention of 0.71 for 100 kilometers. So just tying into Alex's point about patents, innovation, and just China moving from a producer of low technology commoditized products several decades back to really bleeding edge technology, even in the space of things like electric vehicles and autonomous technology as well. But let me come to one of the concerns, and I promise to spin that into the conversation, Alex, today. The technology conversation can't be had without bringing in the trade wars or the tech wars with the US or the West. What are your thoughts on how do we as investors navigate this complex environment of trade or tech wars?
Okay, well, look, that's a very fair question. And the first thing is not to evade it. The first thing is to say, get used to it. Because we're going to have tension between China and the US for as long as we're all working. And I say that because you can't go from a unipolar to a multipolar world. You can't go from having one superpower to two superpowers without both of them feeling intensely nervous about how that pans out. So first, learn to live with it. The next thing is to say that there will be very different pockets of opportunity from this trade tension. And there will be some downside, for sure, but there will also be upside. And the two countries can't decouple entirely because they need one another. They both buy things from one another. If this is any variety of Cold War, it's not at all like the US-Russian Cold War, where in essence the countries could live in isolation from one another. China and the US are, whether or not they like it, they're joined at the hip, but that doesn't stop them pulling apart at times. So let's have a look at the next slide, because actually one of the answers to this question, Supreet, one of the implications of trade tension is that China's innovation has laid the way for China to do things itself. And so what we have here is a chart showing accelerated import substitution in certain areas. It is the number one rule of life that whenever politicians do anything, the law of unintended consequences kicks in. And one of the unintended consequences of US policy around China is that China has become very, very determined to become self-sufficient wherever it can. So there are some areas, for example, the most sophisticated semiconductors used to power artificial intelligence, where China still relies upon imports from the US. Okay, but there are other areas, and they're in this dotted oval on this page here, things like office software, robotics, speed reducers, wafer cleaning, etc., integrated circuits, where China is now making these things itself. And if we take office software as an example, there are Chinese companies such as Kingsoft, which are basically the domestic equivalent of Microsoft. So they can do everything that Microsoft does. And if you were looking to upgrade your office systems at the moment, and you thought, well, I can either buy a US product, which actually isn't designed for my market, and there is any risk at all of having it cut off because of these tensions, or I could buy a domestic product. Well, I think the answer becomes really quite clear. And so that's what we're seeing, is that this innovation is powering self-sufficiency in China. And the unintended consequence of geopolitics, or one of them, is that China is making a whole lot more things for itself. And if you buy the companies which makes those things, then that is an opportunity.
I'm going to expand the conversation here a little bit, because I pointed out that this strategy is not just China onshore and offshore. It also invests into Taiwan. So stay with this chart. And on the x-axis, you see as you go from left to right, it gets increasingly high tech. So the part that China's not been able to nail, which is lithography, wafer fabrication, well, we're able to buy in Taiwanese names. So Taiwan Semiconductors, which is a leading name in, I beg your pardon, in global semiconductor supply chain, is a leader where they have more than 50% market share of made-to-order chips. 50% market share of semis with nodes of 28 to 65 nanometer, which essentially are the nodes that are used in regular automobiles. But the moment you go into bleeding edge semiconductors, like 7 to 10 nanometers or lower, they actually have 90% market share. And they're the only semiconductor manufacturer which is working on producing nodes of 3 nanometers. Just for context, the faster you want your computer to be, you want to put more transistors into smaller and smaller areas. So you want to cram as many transistors as possible in smaller areas. So 3 nanometer node is just every transistor in a 3 nanometer node is 1/20,000th the size of a human hair. Now, that level of technology and innovation is not something which even a player like Intel can aspire to have in any foreseeable future. So while China may not have nailed it, TSMC is one of our largest holdings. It's in fact our top 3 holdings in our portfolio as well. Just switching gears a little bit, and another beneficiary on the next slide of widespread technology adoption is that of e-commerce. Call it beneficiary of technology-enabled businesses, or for that matter, millennial trends, or just general consumption patterns going online. So on the next slide, you will see the China e-commerce business. On the left-hand side, it's showing you the significant increase in the share of total goods that are sold online. On the right-hand side, it's showing you that even sometimes the non-discretionary consumption, whether it's food, apparel, or other daily use products, have seen significant pickup. Now, these numbers are not percentage of overall goods sold, they're year-over-year change. So when you read this, look at food, it's improved year-over-year by 30%. Apparel's improved almost 40% year-over-year. So significant growth in the business that's happening online. And even now, the penetration rate of e-commerce in China still lags a country like the US, where clearly Amazon and some of the others have really benefited from that as well. This brings me to the elephant in the room, Alex, which is all this news around regulations going after some of these big tech and particularly e-commerce companies, and particularly consumer-facing technology companies in China. How do we deal with that?
Well, the first thing to say is that not all regulation is the same. And I think this is why local expertise is so important. Because if you manage your portfolio based off what you see in newspaper headlines, then you could get the impression that there is a sort of a homogenous approach between the Chinese regulator and the internet sector. And we just don't believe that's the case. So the first thing is to figure out what we're looking at. And on the next slide, we've got some bullet points around this. But the core of what's happening here is that there are different sorts of concern. So one of the concerns would be around the inappropriate use of market power. So someone like Alibaba demanding exclusive access to the people who distribute their goods through their e-commerce platform. So that's around just being too big and being a bit naughty with that. Then we get something like Ant Financial. And the concern there was around sort of gray areas in regulation and what can be done about that. And then we've got other areas again, like so Meituan Duanping, which is a food delivery service. And there was the concern there, not so much that they were mistreating the vendors who use them, or that somehow they were mistreating their customer data. In this instance, it was how they were paying their drivers and the insurance programs they were giving them. And then we've got something else like Didi, which has been very high profile recently. And that was around their decision of where to list. So I think what we need to do here is just say, first, understand the nuances of regulation. And the second thing is to understand that in some cases, the decisions made by the regulator will materially impact the long-run profitability of a business model. And in other cases, actually, all they're trying to do is enforce a bit of good behavior. They're trying to prevent the big boys from stopping younger innovators coming up. And actually, in those cases, you normally get a sell-off in the share price, which provides an opportunity rather than something to panic about. So a name like Alibaba is very, very familiar. But what we think there is that this is a company whose long-run earnings potential is broadly unaffected. They brought forward some investment. They need to be seen to be behaving very well for a period of time, but it's still just a phenomenal business. And so for a stock like that, we will add into weakness. There are other areas, and maybe something like the education sector is not specifically around the internet because you can get online and offline tutoring. But here we think that the government's steps to prevent consolidation in the sector or to slow down consolidation in the sector will actually materially impact the economics of the business in the longer run. And so there we are more likely to fundamentally change our view and exit. So I suppose the punchline to that, Supreet, is we need to live with regulation. It's not only in China, it's in the US, it's in Europe, and we all know it's also in India. But you shouldn't treat it all the same. And you can be very unemotional and figure out when this is an opportunity to add to a position and when you need to change your view.
I like this chart not because of the left-hand side, because that's the short-term concern that I was alluding to, but the long game's on the right-hand side, which is really speaking about the growth, both of the retail sales online or even cloud computing business as well. To your point, Alex, news headlines aren't necessarily going to flatten this curve, if I may say so. It's really structural in nature and impacts different businesses to different magnitudes, and which is why, as active managers, we tend to own beneficiaries of those changes or those shifting sands, while trying to identify those losers who are probably going to be disadvantaged in such an environment. So, this is where you want to be invested into active strategies like ours as well. I noticed a number of questions coming exactly on that question. I guess, in addition to the questions that I've seen, which you've mostly answered, Alex, the next question is, what are we doing in the portfolio as a response to some of these regulations? Are we exiting any stocks? And, of course, please do bear in mind your embargo of what you can speak about. But broadly as a trend, is this something which is disconcerting? Is it going to change the nature of our portfolio? Or as you rightly mentioned, or you pointed out, in some cases, you're actually using this opportunity to invest a little bit more into what are great businesses at a much better bargain?
Well, sure. We're always going to say that we're investing in great businesses. That's the core of what we do. So this strategy is a growth-oriented strategy. So we're not going to move away from that growth, but it's also got a strong quality tilt. And what I mean by that is we want to buy businesses which aren't just growing quickly, but at the expense of earnings or cash flow or their future prospects. They've also got, over time, sustainably high ROEs. They've got returns in excess of their cost of capital. They've got robust balance sheets. They've got barriers to entry. They've got these deep moats that we like to look for in companies. And one of the ways that we deal with regulation is to do the hard work of identifying companies which are going to succeed, not because of something the regulator's done or not because of some short-term geopolitical impulse, but because they've just got the best products, they've got a good strategy, they've got execution in the longer run. So we always come back to those points again and again and again. And I think that the right-hand side of the chart that we can all see is interesting because there are lots of J-curves in China, but that doesn't mean that every company will make money out of them. And you do need to figure out which businesses will do best. And so what we've done for Alibaba is we model all these companies 5 years forward. We think that it's still got very robust earnings power in the long run. We think that management knows exactly what they're doing. And although the government is trying to just, as I said, encourage them to behave a little better to prevent there being a squeezing of innovation more broadly in China, the government also knows that these internet companies are integral to the development of the Chinese economy, and they're not going to dismantle them. Conversely, there have been some other areas where we've either thought that a less robust competitive position will be exposed by this, or we think that the valuation hasn't taken it sufficiently into account. And so I think we've probably doubled down on some of the quality aspects of the portfolio, and we're just that much sure about the long-run sustainability of the companies we invest in.
I'm getting a lot of questions which are essentially more around facts for China. And let me just say, for those of you who are posting those questions, because of lack of time, we won't be able to address a lot of them, but I assure you a lot of those questions are answered in our publication called Guide to China. If you haven't seen it, please reach out to your relationship manager, Edelweiss Asset Management. This is a quarterly publication which actually produces a lot of information and insights and charts and graphs. Many of them, by the way, we've used, whether it's the GDP per capita, and some of those slides that we've used are actually from Guide to China. So if you want to demystify or learn more about Chinese markets, please do go to our Guide to China and refer to that information as well. But just staying with how perhaps the Chinese markets aren't the best known, Alex, how do we, we've discussed so far, Chinese markets are the second largest in terms of the size economy. The Chinese consumer is significant, both for staple as well as, more importantly, discretionary consumption. Technology is an area where they are, one of the leaders as well. if investors want to monetize, there are a number of ways of doing it. So, speak to us about what do onshore China and offshore China mean, and why is that important for an investor, given the changes that are taking place?
Okay, for sure. Now, there's a simple answer to this and there's a complicated answer to this. The simple answer is ultimately what we want to do is just find the best businesses. And we don't really care where they're listed, because we don't have to, because whether they're listed in the A share market or the H share market or in Taiwan or in Hong Kong, we can access them. Doesn't mean that you can, other than through a vehicle like ours, but we're able to. So that's the simple answer, is just find the best companies and later on worry about where we invest in them. Having said that, there are different markets here. So the onshore market is the A share market. And that's what we can basically see represented on these slides here, which is that not that long ago, that was excluded to foreign investors such as ourselves, or such as yourselves as well. And the government has taken steps to open that up. So with the right mechanisms, things like Stock Connect or through participation notes, we can invest in that large, liquid, inefficiently priced onshore market. Now that's exciting because there are some terrible companies there, but there are also some excellent companies there, and they're not particularly well understood. And so that's a core part of our portfolios. Then we have the offshore market, and people often talk about the H share market. And this is divided into two pieces. We've got a lot of state-owned enterprises which listed offshore basically to use foreign capital to build infrastructure for Chinese people. And typically, that's not an area that we're really interested in, because they're capital intensive, they're run by the government for the people, not for the minority equity investors. They've got lower returns. And I'm thinking about things like the energy companies, some of the utilities, some of the telcos, or some of the very big banks. But then also in the offshore space, we've got the internet companies, the tech giants. And while, as we've discussed, there are some headwinds in certain areas, we also think that many of these are going to continue to be the leaders in the market for a really long period of time. And then we've got the Hong Kong domestic market, which is around real estate and banks and things like that. And as Supreet said, we then got the Taiwan market, which has got some bits we're less interested in, financials, consumption, and then bits we're incredibly interested in, particularly in technology, because there are some just world-beating companies such as TSMC. Now, one of the intriguing things about this is that it means we've actually got a choice of lots of different ways to play what we think is a really exciting asset class. It also means that we can, when we find the best businesses, we've got ways of playing them in the different markets. And the other thing just to say is that although we get this, there are plenty of foreigners who don't yet. So foreign holdings of onshore equities in particular are only going to increase over time. And what the right-hand side of this chart basically shows you is that if you compare Chinese share of GDP with Chinese share of investable indices, it's still very underrepresented still in stock markets. So we start with the companies, always start with the companies. But having found companies that we like, we know that there is a sort of a wave of capital behind them, which over the long run, I think is going to carry on supporting this asset class. Now, what we might do, just to reiterate the point, is on the next slide, please, which is, you can see here, there's that sort of inflection point on the red line on the left-hand side, where China opened up more to foreign investors. And the net non-resident purchases, went from being pretty flat to just going up very steadily over time. You can see that in the fixed income market as well. And we think that will be a supportive factor for this asset class. Look on the right-hand side here. Although our bread and butter is investing in Chinese companies, including in the A-share market, there is a very substantial percentage of investors who've got no exposure to this at all. So I would say the punchline to this, to all of you, is partly, there's more money coming in this direction, which is always reassuring. The second thing is it means that we are investing in opportunities which other people don't know about because they're not listing, they're not looking. And then the third thing, which maybe we'll come on to in a bit more detail later, is to do this, though, you do need local expertise. Because if you are, two people and a Bloomberg terminal sitting in the Midwest of the US somewhere, and you've got no exposure to A shares, and you think that you want to navigate the geopolitical trends and the regulatory environment, etc., it's not as easy as that.
I'm only going to add that no trend is ever a straight line. And I say that in the context of several questions that I've received from our partners at Edelweiss around the tech-related regulations leading to outflows from foreign investors. If you follow that red line that Alex was alluding to, it's never a straight line. It's always jagged. Whether it was 2018, where you saw a small dip because of trade wars during Trump's presidency, whether it was 2020 during the pandemic and the initial lockdown, you always see these near-term reactions. But as long as you're convinced about the long-term trend, and hopefully what we've spoken about is expressing that long-term trend, and that's intact, these short-term news is more an opportunity for you to build positions into what is an opportunity for the long term as well. Alex, maybe for the next segment, and let's switch gears a little bit and start bringing this home in terms of our portfolio. Which themes and sectors represent this long-term opportunity, and how are we positioned in our portfolios?
Great. Well, let's go to the next slide, please. And I hope that nothing on this slide will be a surprise given everything we've talked about thus far. So starting on the bottom of the page, maybe just to sort of shake things up a little bit. The first point that Supreet made is that the growth of the Chinese economy is leading to this burgeoning middle-class consumer demographic. And so there are plenty of opportunities to benefit from consumption in China. And we'll explore that in a little bit more detail. But let's get beyond that, because if people are just buying things, but the companies aren't producing anything which is really worth selling within China, then you don't have the investable story. And this is where healthcare is so exciting. For example, we know that as people get wealthy, they're going to spend more money on their bodies and on their minds. We also know that the pandemic has only concentrated people's energy that they need to look after themselves. But if all the drugs people buy are made in the West, that's not interesting for investors in China. And one of the really exciting areas we see is this growth of Chinese healthcare companies who are producing drugs or services or facilities such as eye hospitals, specifically for Chinese and then later for international people. And then to the top of the page, because we've talked about this a little bit already, we've got technology where very explicitly it's not just around the demand, it's around China's ability to satisfy that demand with its own companies. And so let's flip slides and take a look at that in a little bit more detail, please. So on the next page, what we see here is an area which is at the conjunction of more than one of these forces. And we've already talked a little bit about EV, but more broadly, one of the things the Chinese government wants very badly is to have a more sustainable environmental picture in China. So that's the demand side. And you can see the Chinese production of global solar components, whether it's polysilicon or solar glass or wafers, is just a huge percentage of the global total. The question then is, how do we monetize it? And a stock like LongE Green Energy, which has just made our clients a lot of money over the past 18 months, it's the largest silicon wafer producer globally. It's got cost leadership, and of course, the bigger you get, the more you can drive down your marginal cost of production, and with a truly impressive global market share. So this is a world-leading company, and it's well positioned to benefit from, as you can see, from the industry secular growth, but not because there's anything particularly Chinese about there, but because it's just got a very, very strong competitive position. So that's the sort of thing that we like to invest in. Or we've got Tongwei, which is a polysilicon and cell producer. So these are components which go into solar power. It's got technology leadership, but it's also got very strong cost control. And as we've seen elsewhere, it's their ability to keep reinvesting in R&D, to use this leading position to generate cash flow, to spend R&D, to keep ahead of the curve, which is really valuable there. Now, again, I'm going to ask you just to cast your mind back 20 years or so ago to your perception of China, and to ask yourself, did you think China in those days was going to be a world leader in things like polysilicon or in R&D in solar, or in these quite high-tech things which is powering a greener planet. And I don't think that was the case. So this is something which is new and exciting and isn't going to stop anytime soon. Let's take another example on the next slide, please. And this is really something quite different. So having talked about high tech, we're going to talk about something which, on the face of it, is much lower tech. And this is around property management. Now, as consumers get wealthier, they don't just want to buy electric vehicles. They don't just want to power their apartments with solar power. They don't just want to use Chinese medicine. They also want to live in more professionally managed apartments. They want to shop in areas where the malls and things like that feel like they're really first world, bright, well lit, etc. And beyond all of that, of course, people are more worried now about the health environment, so they want to make sure that everything is being disinfected, that there's good control over health, etc. So, Country Garden Services is a property management company. It's helping to consolidate the industry. So it's making more money as it absorbs smaller players who are being squeezed. It's got a good brand name, so people want to use it. And this is a different example of the sort of way that you can benefit from the Chinese consumption story in areas which maybe aren't immediately obvious to your average foreign investor. So I think we've had some quite high-tech conversations, and this is just around execution, consolidation, and running the company well. Now, if we pull all of that together on the next slide, what this means is that our sector positioning within the Greater China Fund is really very clear. It's overweight IT, we're overweight healthcare, we are overweight consumer names and communication services, by the way, that includes internet. So that's all new economy. And then the key area of underweight is in financials, to some extent in real estate. And we don't want to invest in the big Chinese state-owned banks. We know that they're not being run for our best interest. They're being run sometimes for the borrowers and not for the people who have funded their balance sheet. So we are underweight old economy, overweight new economy, and that's a style footprint which isn't going to change anytime soon. So that's how all of the things we've talked about are brought to bear in the portfolio itself.
One of the frequently asked questions, Alex, and I've put that forward to you several times, but I think it's important to bring that up, is general perception that the market in China is opaque. The data is not consistent, and if it's consistent, it can't be trusted. I claimed in the opening comments that we've got a deep research team. How do we navigate these characteristics, whether it's opacity or inconsistency of data? So if you have to choose the long-term winners, how do we do that?
Well, the first thing is I'm not going to disagree with you, Supreet, that there is some opacity out there, and that there is variable data. That's totally fair, and it would be incorrect of me to deny that. But there are ways around it, and there are a lot of misconceptions out there. And guess what? One of the first ways to get better data in China is to be able to read Chinese. So let's have a look at the next slide, because this is the team which manages the portfolio. So on the left-hand side at the top left, you can see Howard and Rebecca. They are the PMs specifically for the Greater China Fund. And then in the middle, in the green box, this is a team of 14 dedicated Greater China analysts. Now, they're supported by regional and global sector analysts who are in the box on the right. But let's just spend a moment looking at this team in the middle. I don't know if you can see it, but let me tell you, they are all Chinese. They all speak Mandarin. They read Chinese. They're based in the Greater China region. So this team of analysts is spread across Hong Kong, where I'm sitting, Taipei, and Shanghai. And for sure, not all data is disclosed in English. But that's okay, because we can read it in Chinese. And one of the really interesting things we find is that consumers of data or processors of data, for example, MSCI, when they're looking at ESG data, they pretty much insist on doing it with English language materials. But that's nonsense. In the same way that US companies don't feel they need to report in Chinese, it's not necessary that every Chinese company will disclose all information in English. I don't know why we would expect that. And so we make sure that we can use this very well-resourced, fundamental, bottom-up research team to really figure out what's actually going on. And I think that by combining that, a global, developed, very sophisticated analytical framework with all of this local expertise, which we have represented on this slide, I think that's really the key answer to your question, Supreet. And then we have to be selective, for sure. There are some shocking companies out there. But there are in India, there are in the West, there are in the States. There's no Chinese monopoly on that. It's about finding the good ones.
How's your Chinese, Alex?
I'm
sure you can score a beer when you're in China. I'm sure you can speak enough to score a beer, right?
Well, that's a deeply unfair question. This is why I'm not running the portfolio. My Chinese is not what it should be. But
like I said, as long as you can, you've got the survival skills. We're happy with it.
I can. Yes,
let's
exactly.
try and bring this together. Sorry, Alex, go ahead.
No. I've for once I'm lost for words. So let's go on to the next slide. And we can wrap things up.
I hope this is recorded because it's not very often that you're lost for words. So I'm going to take this recording and keep it for posterity. So the next slide, let's try and bring this together in terms of what do we do in the strategy and look at some of the characteristics. So performance was on the bottom left-hand side. The two portfolio managers are given on the top left-hand side. So Howard Wang, who's also the head of the Greater China team, as well as Rebecca. Howard's been managing it for the past 16 years. I must point out that even though this fund is 12 years old in India, this strategy or this fund otherwise is actually 20 years old now. So you notice on the top right-hand side in that table, it's mentioned date of inception as 18th May 2001. It is an all-cap strategy, close to about $3.2 billion in size, and typically we like to hold about 50 to 70 stocks in the portfolio. If you look at the bottom right-hand side table, you notice that the PE multiple of the fund is slightly higher or higher than the benchmark at about 24.5. But we are happy, as Alex pointed out, we are quality growth investors. We're willing to pay a premium for those businesses. And which is why if I ask you to look at the third row from the bottom, that really is what drives the performance of the fund over the long term. So the 5-year expected growth, and this is earnings growth of the portfolio, is expected to be about 17.7% annualized over the next 5 years compared to slightly less than 16% for the benchmark. So we are paying a slight premium over the benchmark in terms of valuations, but for a reasonably higher earnings growth as well. If you look at it, give it a quick glance on the left-hand side, these are US dollar performance. So 5-year returns about 25.6, 3-year about 23%, and since inception of about 14% annualized numbers as well. And across those periods, the row on the bottom, which is in bold, is actually excess returns, or as we like to call it, the alpha of the strategy as well. Next slide, which is going to be the final slide of our prepared remarks. I will encourage you to keep posting in your questions, and I'll try and take as many and put them forward to Alex as possible. So hopefully through the course of the discussion, you've heard us speak about those 3 key takeaways, but this strategy in particular, I'm going to park this slide for you to absorb. To me, even though we've claimed our expertise and our strength, the real testament is that third-party testament, which we've given on the top right-hand side. It is a Morningstar Silver analyst rating. Of course, it is a 5-star rated strategy as well. Alex pointed out those 14 Greater China analysts, but in total about 22 investment professionals that are dedicated to Greater China. It is a best ideas portfolio with a quality and growth bias as well. As we just referred to, long-term track record, which is extremely strong, and the fund has consistently outperformed its benchmark net of fees as well. I'm going to very quickly refer to the 3 key takeaways that I started out with, which is China is significant. It is the second largest economy. It is the second largest capital market, and increasingly getting prosperous. That's leading to opportunities in beneficiaries of widespread technology adoption, consumption, healthcare. And finally, hopefully over the last few slides, we've managed to convince you about the fact that the JP Morgan Greater China Fund is a leading strategy with a proven investment process as well. So with that, let me pivot to questions. And I know there are a number of those questions which have come. And by the way, there are an overwhelming number of questions which pertain to the regulatory action. Hopefully we've answered that. And let us know if you have got a twist or a separate question to that as well. Let me take a question which came up on semi shortages, Alex. Is that potentially a challenge for our portfolio, or do we stand to benefit from this semi shortage? We spoke briefly about Taiwan semiconductors. Are there any other semi plays in our portfolio as well?
Yeah, sure. I think that's a super question. And the answer is we've got lots of different semiconductor plays in the portfolio, whether it's a stock like TSMC, there are names like Star Power or Maxend in the onshore market. We've got companies which are different parts of the semiconductor complex. And I think that the fundamental point here is whenever you're trying to find an investable opportunity, don't just look at it head on. Every company exists in a competitive universe, and every company exists in a supply chain. And so when we look at semiconductors, or indeed real estate or financials or what have you, we always like to look up and down the supply chain to find the real sweet spots. And we've got companies in the portfolio which have been beneficiaries of the tight semiconductor supply because they've seen their prices going up. So it's about understanding the margin dynamics, and also just figuring out how to position yourselves for those. I want to go back to EV actually to elaborate on that, because it's one of my favorite examples. When people talk about electric vehicles in China, they typically go to the brand names. They look at stocks like NIO or XPeng, which Supreet mentioned earlier, and they think, well, surely if Chinese people are buying lots of cars, then this is the best way to monetize it. And we firmly disagree with that. We think those are expensive stocks. We can't bet yet on a winner. But we do know that CATL, Contemporary Amprax, has got more than 50% market share of batteries sold to all electric vehicles. So why would you bet on one brand owner if you can buy the company which supplies all of them? And if we think about semiconductors, it would be a similar story, which is maybe in semiconductor equipment, we don't have to worry too much about any individual producer. As long as we've got the equipment manufacturer which is servicing all of them, then we think we're in the right space. And I think that's the power of having such a well-resourced team, is not just to look at a trend, but to get underneath the surface of it.
Thanks, Alex. Slight twist on the question on regulations, and particularly around big tech. This is trying to explore if there's an opportunity within some of these large big tech names like Alibaba and Tencent, when their subsidiaries indeed do get listed, are they currently factored in their stock price?
Well, I think that we don't always have, these are complicated companies. And I don't think we've always got the disclosure, frankly, to know what the component parts would be worth in the stock market. But for sure, this is an area of opportunity. It's an area of opportunity because the underlying assets will be worth more over time in the better companies. But also because, of course, you can benefit from investing in the spin-offs, irrespective of the sum of the parts. You can make money out of those during the IPO process as well. So we had a very close look at Ant Financial back when that was a potential listing. There are many other companies in healthcare, in the music area, in gaming, and things like that, which we've looked at. And we are careful but active participants in the IPO market. So I don't want anyone to come away from this call thinking that we use IPOs as a way of deliberately driving the majority of the value in the portfolio, but it's certainly one area that we look at.
I managed to catch a question which is factually inaccurate. The question is, why is the Greater China Fund rated 2 out of 5 stars by Morningstar? As I just mentioned just a moment back, it is a 5-star rated fund. I don't know why the Edelweiss feeder would be rated by Morningstar. If you go into Morningstar's website and look up the fund, it actually alludes to the master fund, which is the JP Morgan fund that we're discussing today. It gives it a 5-star and also mentions the silver analyst rating as well. So I just wanted to correct that very quickly as well. The other question is around the impact that we foresee on listings in the US or other markets, Alex. Is that a cause for concern? Because it's, one of the perceptions is that Chinese regulators are particularly going after those businesses which are listing overseas.
Yeah, thank you. I'm glad you brought that up because I should have mentioned that already, and it's a very important point. I think this is actually a really peculiar issue because if you think back to last year, and there was one of these periodic increases in tension between the US and China, one of the things the US did was make it harder for Chinese companies to sustain listings in the US. So they basically changed some of the data requirements or the disclosure requirements for Chinese companies to list in the US. So the US made it harder to list ADRs. And one of the things which happened on the back of that is that companies like Alibaba then either listed in Hong Kong or had secondary listings in Hong Kong or revived them, which meant there was this flow of liquidity from the more liquid US stocks to Hong Kong. So we had a virtuous circle where the more people looked in Hong Kong, the more the liquidity picked up, the more that other people were able to look, etc. Now, what's happened with Didi is we think that a pretty strong signal has been sent by the Chinese that they also don't want companies to list in the US. And this is partly around fears of data leakage, it's around cybersecurity, it's around just general geopolitical aggravation. But what appears to happen is that the two countries have reached a rare point of agreement, which is that the Americans don't really want Chinese companies listing in the US as a punishment. And the Chinese also don't want Chinese companies listing in the US as a punishment. And we're sort of left shrugging our shoulders thinking, well, that's okay, because we made a lot of money in Hong Kong Exchange, which has seen its business really pick up on the back of this because more people are trading Chinese stocks in Hong Kong. And we've got a very viable capital market here in Hong Kong where I sit, and people will trade these stocks in Hong Kong instead. So I think we're going to get to a point quite soon where this is old news and people will substantially stop investing in ADRs maybe, and they will just invest in the Hong Kong listed units instead. And that's fine. There's no handicap to trading in Hong Kong. There's no impediment to it. It's an open and liquid capital market.
Thanks, Alex. The next question is on the triple R cut that came through last Friday. Is that the sign that consumption is slowing in China?
The pace of recovery is slowing in China for sure. But it's not, I think you've got to be very careful in any market, but particularly a place like China, of just saying, well, consumption is slowing. It's more around certain areas. So we think that the Chinese economy is stable and solid. We also think that actually, if anything, the government is relaxed or would be happier with a somewhat slower growth rate than was the case in the past. And there are areas such as real estate where they're still trying to clamp down on leverage. But it's also a signal that maybe there's a little bit of pressure in certain areas for lending. And so we think on balance, it's still probably more of a tightening than a weakening environment, but the triple R cut is designed to just finesse the path through that. Now, the Chinese government, the regulator, the central bank, etc., I don't want to say they micromanage, but they do like to get very involved in lots of different areas of the economy. So although it sounds weird or maybe a bit unusual, I don't think it's inconsistent in a Chinese context. They generally want they want to control the growth of balance sheets, but at the same time they're happy to have a triple R cut just to make sure that the economy ticks along at the moment through this latter stage of the whole sort of COVID dynamic.
Thanks, Alex. Top of the hour, we'll take just two more questions in the interest of time. One question is on currency. In fact, there are a bunch of questions on currency and the impact of currency on investors. If I can ask you to go back 2 slides, please, to the sector and currency positions in the deck. I want to demystify that a little bit because one more slide, please. So if you look at the bottom of this slide, that gives you country allocation. So China is shown as about 70%, but that China is 51% in others, which is a combination of H shares, which are Hong Kong listed shares, as well as ADRs. The onshore listed shares, which Alex explained that we can access, is close to about 19% of the portfolio. So the actual renminbi exposure is that, which is about 18.6. If you look at the balance, which is 51% in China, that is, 51% listed outside of China, which is whether the US or Hong Kong. Hong Kong dollar is pegged to the US dollar, so that's a proxy. Hong Kong shares are again Hong Kong dollars, so again a proxy. And Taiwan, which is about 25% of the portfolio, is new Taiwanese dollar. So I would just say that you're not investing into this strategy for currency fluctuations. If you do benefit from those currency movements, which is US dollar appreciating vis-a-vis the rupee, that's an icing on the cake. But really, the essence and at the very core is the investment case. And hopefully we've been able to present that over the course of the last 1 hour as well. Final question to you, Alex, and which is around emerging market equity fund and the fact that both strategies are available in India. What is the overlap between the two? And how should one think about choosing between the two?
Well, so China is the single largest percentage of the emerging market fund, and I don't have an exact figure in my mind of the holdings overlap between the two. But when you're buying an emerging market fund, of course, the biggest chunk you're going to get will be from China, Taiwan, etc. Now, I think the way to think about this is that an emerging market fund will give you the best that China has to offer, but also it recognizes that China doesn't have a monopoly on good companies, and you can get names like Samsung Electronics in Korea, you can get South African pharmacies, you can get Latin American e-commerce, you can get Belarusian software services. So there are all these different great individual stories that you can play, and it'll give you a lot of China, but also some very high quality companies elsewhere. But I think that what we find is quite a lot of people have already got some emerging market exposure, and they want something a bit more targeted at the margin. And that's what the Greater China product will give you. Is we still think this is the biggest story of the next investable generation. And if you've already got some emerging market diversified exposure, this will just increase your portfolio holdings in some of the most dynamic areas. So there's no perfect solution for everyone, but I think that's how I would draw the distinction between the two: a bit more diversification versus a bit more concentration.
Slight difference in the style as well, Alex, because emerging market portfolio is more value and quality, while the Greater China portfolio is growth and quality.
Absolutely, but I think in the long run, what you're going to see here is a focus on the highest quality franchises, which will persist ultimately. So this will be a somewhat more volatile portfolio, I'd say, than emerging markets. It is more concentrated. China, of course, is a volatile asset class. I think, though, I wouldn't look at the style dynamics in terms of driving your longer run investment decisions. It's more around the degree of concentration you're comfortable with, because either way, what we're trying to do is buy high quality companies on behalf of our investors.
Thank you, Alex. Really useful. I think this brings us to the end of the webinar. I just want to take a couple of minutes to thank all the participants for their time and the questions as well. I do apologize we haven't been able to take all the questions. I note some of those questions that I alluded to earlier are addressed in our guide to China. I hope you reach out to your relationship manager, take a look at the guide to China, and a lot of those questions will be answered. And some of them are factual questions which are part of the deck. Some questions were, will this deck be available? Edelweiss has this presentation available in their template. You should be able to receive this shortly as well. Once again, thank you very much for your time. Alex, want to thank you for your time and your insights, always very useful and helpful. And I certainly look forward to going in person to India for a roadshow along with you. And I promise you, I have the survival skills, even though you don't need those in India. You can score beers all on your own. But instead of doing virtual calls like this, I'm sure Alex joins me in expressing that we look forward to seeing you all in person sometime. Right, Alex?
I can't wait. We can test autonomous driving in Nariman Point and see how well that lasts.
Thank you, everyone. This concludes the webinar for today. Stay safe and appreciate your time once again. Thank you.
Thank you so much, everyone. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.